Is the Canara HSBC Wealth Edge plan the key to long-term wealth creation or just another market-linked gamble? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision and also to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is a unit-linked individual savings life insurance plan. Some of the key features of the policy are you get to ensure your family's financial security throughout the policy term, and you also get to enjoy flexible premium payment options like one-time payment, limited period payments, or paying throughout the policy term. And there are 5 investment strategies and 9 fund options to match your financial goals, and you can even adapt your policy to changing financial needs by modifying premiums, payment terms, policy terms, or sum assured. And if you stay invested longer, you can benefit from loyalty additions and wealth boosters from this policy. And the mortality charges deducted during the policy term are refunded back to your fund value at maturity, and you can even access your accumulated wealth when needed through the systematic withdrawal option or milestone withdrawal option, and even maximize your investments with lower premium allocation charge by opting for a higher premium amount. So these are some of the key features of this policy. Now, what are the plan options of this policy? So there are 3 plan options. First of all, we have Invest Plus, second Premium Plus, then third is Life Plus. So under these options, the benefits also differ. So it has death benefit, maturity benefit, loyalty additions, and wealth boosters. But as I previously mentioned, the benefits differ based on the plan option you have opted for, especially in the death benefit and maturity benefit. So under Invest Plus, Premium Plus, and Life Plus, you can see that under all those options presented on the screen, on the death benefit, if the policyholder unfortunately passes away during the policy term, then the options presented under each plan option is whichever is highest out of those at the date of death, that will be given as a death benefit to the policyholder's nominee or legal heir. And this also differs in the maturity benefit. So maturity benefit is a little bit different for Invest Plus and Life Plus, and it is a little bit different for Premium Plus. So you also get loyalty additions, which is 0.5% of your average fund value of the last 12 monthly policy anniversaries, which will be added to your fund value at the end of every policy year starting from the 6th policy year till the end of the policy term. And we have wealth boosters, which is your 2.90% of your average fund value of the last 60 monthly policy anniversaries, which will be added at the end of your 10th policy anniversary from the 15th policy anniversary, and thereafter at the end of every 5 policy years. So the wealth booster rate is 1.50%. So if you want to know more about these benefits in detail, you can refer to the policy brochure. Now let us take a look at the fund options available under this policy. So first is Emerging Leaders Equity Fund, India Multicap Equity Fund, Equity 2 Fund, Midcap Momentum Growth Index Fund, Growth Plus Fund, Balance Plus Fund, Large Cap Advantages Fund, Debt Fund, Liquid Fund. So there are 9 fund options, and you can see all these fund options are presented on the screen, and you can pause it and see that all these fund options are categorized based on how much percentage of allocation they have to each asset class like equity, debt securities, and money market, and also according to the risk profile each fund has, like which can range from low to medium to high or even very high. And there are 5 investment strategies. First is Systematic Transfer Plan, second is Return Protector option, third is Auto Funds Rebalancing, fourth is Safety Switch option, and fifth strategy is Loss Protector strategy. So out of these options, whichever you think will be suitable for your financial needs and for your financial goals, you can definitely opt for that one. So now what are the charges under this policy? So the charges are, first of all, premium allocation charge and also policy administration charge, Mortality charge is something they are charging you for giving you life cover. And premium funding benefit charges, fund management charge, which will differ based on each fund option you have chosen. Like higher the risk value, risk profile the fund option you have chosen has, the higher your fund management charge would be. So based on that it will differ. And you also have like surrender discontinuance charge, but the switching, partial withdrawals are all free of cost, and there are no miscellaneous charges. But still the existing charges does act as additional cost for investors. Since some charges continue throughout the policy term, they gradually erode your returns over time, reducing your overall profitability from this policy. Now let us take a look at the advantages of investing in this policy. So partial withdrawals are available from the 6th policy year onwards, provided the life assured is at least 18 years old. Second, settlement option can be chosen under the Invest Plus and Premium Plus plan option, and premium redirection is offered free of charge under this policy. Waiver of premium is an inbuilt feature in the Premium Plus option, and you can enjoy unlimited fund switches, and which are free by the way between funds in this policy. So these are some of the advantages. Disadvantages are no loans are allowed under this plan, and you have no access to your funds during the initial policy years, and the sum assured may not be sufficient, and investment returns are also relatively low compared to other investment products available in the market. So these are some drawbacks that you need to be mindful about before investing in this policy. Now, as we have a basic understanding of this policy, let us now evaluate the potential returns of this policy, which is crucial in assessing its suitability. So while this plan does appear attractive due to its market-linked investment option, even for those without technical expertise, calculating the internal rate of return, which is the IRR of this policy, will provide a clearer picture of its actual benefits. So let's analyze a case study from the Canara policy brochure. So here let us assume for calculation purpose that a 30-year-old male purchases this policy with a sum assured of 20 lakhs, a policy term of 15 years and a premium payment term of 15 years. So he pays an annual premium of 2 lakh. He chooses the Invest Plus variant. By consistently paying premiums, he becomes eligible for the fund value at the end of the policy term. However, the assumed returns of 4% and 8% per annum in these examples are not guaranteed and do not represent the upper or lower limits of potential return, as the actual performance of the policy depends on market conditions and various factors. So the 4 and 8% we are taking here to calculate the maturity benefit is just to give you an idea about the worst and best case scenarios. So at 4% return scenario, the fund value is 36.47 lakhs with an IRR of 2.40% as per the plan's maturity calculator. At an 8% return scenario, the fund value is 50.66 lakhs with an IRR of 6.31% in the plan's maturity calculator. So even at an 8% return, the IRR is comparable to or sometimes lower than returns from traditional debt instrument. Given that the Canara policy is a market-linked product, its return should ideally outperform inflation, but they fall short when compared to other market-linked investments. Furthermore, the sum assured is inadequate. The plan also lacks transparency in its investments, imposes high charges, and offers low life coverage, making it an unattractive financial option. Considering the key drawback of ULIP products like the Canara HSBC Wealth Edge plan is a lack of transparency regarding capital allocation, like how much is actually invested and how much goes towards commissions and expenses, and additionally the life cover provider is also inadequate. That's why, to ensure sufficient life coverage and efficient wealth accumulation, it is advisable to separate insurance from investment and compare the potential returns in this comparative analysis. That's what you're going to do. So let us analyze the same metrics as in the previous example. For life coverage, a pure term life insurance policy with a sum assured of 20 lakhs cost an annual premium of 8,100 rupees with a policy term and premium payment term of 15 years. By opting for this, instead of paying 2 lakhs annually into the ULIP, an individual saves 1,91,900 rupees per year, which can be invested based on risk preference. So high-risk investors can allocate funds to equity-based instrument, while risk-averse investors can opt for debt instrument. So here we are going to consider both the scenarios. So pure term plus PPF combination, you can see although the PPF has an annual investment limit of 1.5 lakhs, just for example purpose we are going to assume a higher amount for explanatory purpose, basically making the deviation justifiable. So the final maturity value is 52.04 lakhs, yielding you an IRR of 6.62%. And in the pure term plus ELSS combination, the pre-tax maturity value is 80.12 lakhs, and after accounting for the capital gains tax, the post-tax value is 73.86 lakhs, resulting in an IRR of 10.62%. You can see the tax calculations presented on the screen. You can pause it and see. So the return from PPF is similar to the 8% scenario of the Canara policy, even though PPF is a debt instrument. So it performs on par with a market-linked product. Meanwhile, ELSS significantly outperforms inflation, making it a superior investment strategy. So by separating insurance from investment, this approach enhances risk-adjusted returns, ensures better transparency, and provides greater flexibility, aspects that this Canara policy lacks. So what is the final verdict on Canara HSBC Wealth Edge plan? Is it worth investing or not? So this policy comes in three variants: a standard ULIP and a waiver of premium option, which is an inbuilt feature, and a whole life policy. So while the plan does provide an opportunity to invest in the market, a closer analysis in this video reveals to us that its returns are relatively low compared to other market linked investments. So long term investments are expected to deliver high returns to support wealth accumulation. However, despite being a long term plan, the Canara HSBC Wealth Edge plan struggles to outpace inflation due to its high charges. So this could leave you financially short when your goals come due. So additionally, the plan's sum assured is inadequate, making it an unattractive investment option, and it also has a high agent commission. So if your goal is for long-term wealth creation, it is best to avoid ULIPs like this, as there are more efficient equity investment options that offer higher inflation beating returns at a lower cost available in the market. And also, when it comes to life coverage, insurance and investment should always be kept separate. A pure term life insurance policy is the most effective way to secure your family's financial future.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.